And let's switch gears to inflation. We've seen expectations for the US inflation rate moderating. And of course, bond yields have just collapsed. The reflation, trade, dead, buried and cremated. But our next guest has two words for people calling the end of the reflation trade: calm down. Paul Ashworth from Cameron Harrison joins us again. Oh, that's a cracking intro. Now, Paul, the reflation trade, my goodness, it's just been put to bed. Anyone who's been short treasuries has been absolutely carted out. So what can we expect, especially since US CPI is out tomorrow night?
Yes, I think you described it well there. I think put to bed, but not dead and buried. Certainly, markets have come to better understand, what this more recent cycle of inflation has meant, and it's been particularly focused on goods. So we think of that, in terms of, if you like, a wave of inflationary forces. And whether we're looking at autos, used cars, rental cars, and our focus is obviously particularly in the US there, very sharp increases. But as we've said a few times on the show, the name of the game in Western economies is services inflation. So it's looking past that basket of goods. And that's where we see the potential, beyond this goods-based inflation, to get, if you like, fair income inflation and inflationary expectations, and that's in services. And particularly in the US in terms of shelter. We've seen in Australia some of the rental shelter price increases. Have a look at Perth. They've been phenomenal. 20-30% up in some instances. So that's what we think raises some significant risks in terms of the Fed, their ability to manage an overshoot, and what that, if you like, that next wave of inflation presents. And it'll be in the form of services inflation.
So you don't think inflation is transitory? So that would make sense, given that, as you say, we've hit right up against good supply issues, such as freight and chips and whatever. But we're also having trouble finding labour, because we know labour demand in the US and Australia, for that matter, is at record highs, and yet US sort of labour market reports are a little bit on the tepid side. That's a supply issue as well, and that is how we will get our inflation.
Correct, and it is squarely policy, particularly in terms of the Fed, in terms of their dual policy, in terms of sustained full employment, together with the management of their inflation goal. As it's become here, but with that added element of wages growth. So if we look at the Fed's position in the US, and given that significant component of what services represent in terms of the inflation basket, and the small component that goods represent, we're going to get a 2% inflation target. It's going to see 4% plus wages growth. And really our major concern, bringing it back to a market's position, is the ability for the Federal Reserve, and for that matter of the Reserve Bank here, to be able to manage the overshoot, to be able to see that wages growth doesn't become 5 and 6% wages growth. Now they're all coming out, and Philip Loeb came out last week saying, well, we can manage this. Well, we just take a slightly more jaundiced view as to that, because history tells us that reserve banks haven't been very good at managing these forward risks, and particularly this genie in the bottle, as you put it, in terms of labour and wages growth, this is taking them back to skill bases they haven't really practiced for over 30 years.
And of course, in the meantime, as I say, they're still promising us that even if they taper, it's not tightening. So the RBA has been very clear that even though it tapered, it's not tightening for years. What's your roadmap for the Fed in terms of tapering and tightening?
Well, I think there's a similar issue here in terms of then the credibility of their cash rate settings. So they can reduce their tapering position there, but the market's going to want to see a credible forward position in terms of cash rates and the movement for cash rates, and that's and if you like, the longer that gap is between the tapering outcome and dealing with cash rates, I think that's going to be pretty problematic for markets, and particularly for Treasury bond markets, because I think the longer they do that, the bigger the credibility gap that they will create.
Well, that's going to be fun times ahead. Thank you so much for joining us. Paul from Cameron Harrison, enjoy your day.
You too. Cheers.